And well, fears surrounding the coronavirus, of course, have been escalating. We've got stocks at their lows of the session right now. And investors are wondering what the impact will be on real estate, really as assets across the board, real estate included. Joining us now to discuss is Savills chief economist Heidi Lerner. Savills is a commercial real estate company. And Heidi, one would imagine, there's basically been nothing that has been immune in the publicly traded markets, whether it's commodities, stocks, bonds. We're seeing reactions across the board. What are we seeing happen in commercial real estate? Are we starting to see valuations be affected yet?
I think it's a little bit too early to see valuations be affected, but I would be shocked if we didn't see a decrease in transaction volume. I think what we're going to end up seeing is a lot of deals get delayed into the second half of the year, assuming that there's some type of recovery. A lot of due diligence is going to be stopped basically by people who are unable to travel. So to the extent that somebody was looking at property in Asia, that deal is probably on hold.
Does delay equate eventually a drop in value? Because we're talking about perhaps shifting of supply chain out of China, in some cases permanently.
Sure. I think, again, it's largely going to be a short-term reaction. I think if you think of real estate as a long-term asset, losing income, let's say if you're a hotel or whatnot, for the next 6 months shouldn't really affect long-term valuations. But to the extent that this becomes more of a pronounced problem and people become forced sellers, sure, there could be some downward price pressure.
So are we expecting a bigger disruption in certain sectors like leisure, travel, sort of entertainment? And is that where you're going to see the first shock?
I think the first shock is definitely on tourism and hospitality, and perhaps a secondary shock on retail, and particularly luxury retail, where a lot of Asian buyers comprise a large portion of the market. Already, if you look at tourism into the U.S., I think the numbers are roughly about 2.9 million visitors from China into the U.S. And even in a city like New York City in 2019, it was close to 1.2 million. So you can imagine that's a lot of hotel rooms that are going unfilled, restaurants that maybe are a little bit more empty than they would have otherwise been.
What about data center real estate? Because we're hearing more and more of the tech companies start to talk about issues for their supply chains and then their profitability.
Sure. We've heard from Microsoft, we've heard from Apple, certainly. I think data centers, the demand is still going to be there. It's not something that's going to be disrupted by intermediate products or lack of manufacturing capability in Asia. So I would actually imagine that could be one segment of the market that holds up relatively well.
Realize that your specialty is commercial, but
got to talk about houses, right? Okay.
Is the U.S. house owner or the person who's looking to buy a house somewhat protected because the domestic market is different, obviously, than the international commercial real estate market?
So one could argue that the domestic buyer is actually a little bit better off because we're now seeing a real drop in mortgage rates. We're close to that 8-year low. I think Monday's level was 3.34. So if you're looking to refinance or looking to purchase, that's clearly a positive. I would say that in terms of international purchasers of U.S. residential homes, one of the largest international components is the Chinese market. So to the extent that those buyers remove themselves, perhaps demand is not as robust. But certainly from a financing perspective, you can't argue with where rates are today.
What about this sort of bigger macro question, Heidi, which is, are we living in this new era of the end of globalism? When you talk about international buyers, are you concerned about that just because, you've got so many forces kind of pulling the world apart rather than bringing it together?
Well, this certainly isn't going to help arguments about migration and immigration, when countries start to close borders, albeit for different reasons. Right. But I do think that globalism is a phenomenon that's here to stay. And I think it's one that could actually cause more harm because markets are so much more integrated.
So when it comes to, for example, we certainly hear anecdotal stories, and we've seen data on it as well, where we have, particularly in large coastal cities, building, whether it's commercial or residential, explicitly looking for demand from China or international demand.
Yep.
Do you think that trend is here to stay, even with some of the forces that we've seen?
I think it's here to stay, but I think to the extent that you see a real slowdown in Asia and China's growth begins to slow, I think that marginal demand is reduced. And perhaps that's a short-term effect. I would say that in terms of cross-border flows into the commercial market, last year China was very notably absent, at least relative to prior years. So I think, unfortunately, that's probably a trend that's going to persist into 2020.
Interesting. All right, Heidi, good to see you. Heidi
Thank you.
Lerner of Savills. Appreciate it.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.